Hello and welcome to the first chapter of the Banker's Masterclass series on reducing the risk of correspondent bank de-risking in association with Banking Circle. I'm Joy Macknight, editor of The Banker, and with me is Mitch Trehan, who's UK Head of Compliance and Money Laundering Reporting Officer at Banking Circle. Thanks so much for joining me, Mitch.
Thanks, Joy. It's good to be speaking with you.
So before we look at the history and the impact of bank de-risking strategies, as well as what is driving this trend, can you briefly introduce Banking Circle and tell us about your role?
I'm the UK Head of Compliance and Money Laundering Reporting Officer. So I actually hold two roles within the company. I look after the financial crime aspects and also the regulatory compliance pieces. So unpicking that a bit, that means that from a financial crime, I'm looking at the risk of our clients, policies, procedures, processes, and reporting any suspicious activity to the authorities. And then from a regulatory compliance perspective, I'm looking at everything from product development to ensuring that our marketing is in line with the FCA principles, conduct and culture, and everything relating to PSD2 and compliance with that regulation as well. So that's my specific role, but taking what Banking Circle does. So Banking Circle's a tech-first payments bank. Right? And what we do is we enable other banks and other non-bank financial institutions to move funds and make their payments efficiently in 25 major currencies. And this allows them to deliver fast, secure, and low-cost payments because of our technology stack. We're a fully licensed bank and we're free of all legacy systems. So we're building the technology up as required for our client base. And our solutions allow even the smallest of banks and payment firms to offer competitive banking solutions to their underlying customers without them needing to do a huge investment in multiple systems.
And so I know Banking Circle recently did some research that really looked at the threats that are facing, let's say, Tier 2 and Tier 3 and non-financial institutions from the threats that they're facing from the de-risking strategies of Tier 1 banks. Where, and then importantly, why is this happening?
De-risking isn't new. It's actually been happening for decades. But this current higher level of activity began around 9 years ago. So back 9 years ago, back in 2012, HSBC were fined $1.9 billion over money laundering. That was a money laundering fine. And that started sparking this global, ongoing de-risking movement, which is also linked to the money laundering risk of underlying customers. Where we've really seen a shift was just before that. So I've been doing this for many years, and I really noticed the shift after 2008. Historically, banks and regulators and supervisors all worked closely side by side. Now, don't get me wrong, the supervisors and regulators were always independent, but there was a greater traction between the two about sifting out bad behavior. But after 2008 and the financial crisis, the target started to move. Political will changed, and actually banks were put on, their heads were on the block a bit. And that prompted political change, which prompted a change in the supervisors. And that target started slowly shifting towards the banks, as seen by the fines and the interactions now between banks and supervisors. And that's what started a lot of what we're seeing today. That has created that fear within banks of, these fines are real, these fines are meaningful. What can we do to save ourselves from those? And sometimes the easiest solution for these institutions is just to look at a client base, whether that's a type of industry or a geography, and just decide that the risk of banking it is no longer worth it. And that's what starts that de-risking piece. Sometimes it's just easier to remove underlying clients or sectors than to take that risk of a potential fine coming down. And what this has meant is a lot of FinTechs, a lot of business don't have any correspondent banking partners, or these underlying banks and payment firms need to de-risk their customers to keep their bank happy. And that starts leading to financial exclusion and making it harder for some people to get access to financial services. And we're learning that people are facing a fundamental threat to their operations, which is actually having larger downstream impacts.
Okay, you touched on it a little bit there, but how does de-risking really impact both banks and FinTechs?
So there's two parts to that. The banks, the providers themselves, it impacts them because they're constantly having to figure out whether they should or should not be banking a particular segment, a particular client. But more importantly, it actually really impacts those seeking those services. So the payment firms, the FinTechs, and the smaller banks that need it. And what they've done is they've ended up having to get more and more banking relationships in order to protect in case one of their providers de-risks them. So from all the customers we spoke with, most felt that they had too many correspondent banking relationships. 77% told us that they have more now than they did 10 years ago, and only 6% have fewer. And that's definitely a reaction to the de-risking trends of the last decade. They're protecting themselves from de-risking by spreading that own risk. But with that comes additional problems. Every one of their banking providers needs a de minimis, a minimum threshold, a minimum income in order for that to be a viable relationship. If you're spreading this cost or your payments along 4 or 5 other banks, your minimum fees are across all of those banks as well, which means not only are you paying more to just meet those minimum thresholds, you're missing out on economies of scale. And what we're learning and what our customers are telling us is that for 80% of them, their costs have definitely increased. So they're really starting to feel that pinch and seeing what it means just from protecting themselves from de-risking. But what this also means is if they're worried about being de-risked, they're looking at their own customer base. They're wondering which of our customer base is high risk that could threaten our relationship with our bank. So they end up excluding and de-risking those underlying customers that they would otherwise be supporting. And that just stems larger and bigger financial exclusion. 3 in 4 customers that came back to us responding saying they believe they've lost due to access of both fairly priced and the risk profile of their banking providers. And 71% have told us that they feel the economy would really benefit from an alternative solution.
Great. Well, thank you so much for your insights, Mitch. In Chapter 2, we'll be looking at the state of play of current correspondent banking relationships.